When people talk about private equity, they act like it's one thing, but in reality, it's not. Private equity comes in dozens of flavors: venture capital, growth equity, secondaries, mid-market buyout, large cap buyout, life sciences, and more. Each has its own unique risks, return profile, and role in a portfolio. But the challenge is most investors only ever get a small slice of that universe. And if you try to put it all together by yourself, you run into concentration risk, style drift, and the possibility of underperforming because you simply just aren't diversified enough. That's why I want to talk about what I think is the #1 way to invest in private equity. A way that's diversified, disciplined, and tailored to fit into your investment portfolio, so you're not taking unnecessary risks but still capturing the additional return premium that private equity can offer. And if you stick around to the end, I'll show you how you can make your private equity investments completely tax-free. Okay, and just in case private equity is something that you've heard of, but it's kind of new to you, I'm gonna explain more about the asset class, and I'm gonna use some slides to do it. So we're gonna start with this awesome slide deck that JP Morgan puts together called the Guide to Alternatives. And so the first thing we're gonna look at is just how big of a difference there is in public markets versus private markets. So on the far left, you can see public stocks and bonds, and just how tight the range of returns are depending on which sort of fund or manager you work with. Whereas when we step into private markets, alternative investments, you can see the range of outcomes is much wider. It really matters which fund or product you're in or which manager you're working with. Because if we look at just venture capital specifically, that could have been the difference between compounding at 15% over the past 10 years versus actually a negative annualized 4% a year over the past 10 years if you were with some of the worst managers in venture capital. I think while we have this slide, I would like to mention the difference between private equity and venture capital. It's very time dependent. This happens to be the past 10 years where venture capital has not done well, but generally speaking, you see wider dispersion in the venture capital space, and you'll usually see close to the same median return between your traditional private equity and venture capital. Over the past 10 years, it was even worse. It was, you took less risk in private equity and you actually outperformed the median venture capital. Next, we're going to look at, well, why should we even look at private equity in the first place? And one of the big reasons is that the opportunity set is massive. So if we look on the right-hand side here, we're looking at how many publicly traded companies are there in the US? There's around 3,000 today. How many privately held companies are there in the US? Around 18,000. So 6 times as many companies. And then if you look at the proportion of the private companies, majority of them are actually sitting in the 100 to 490, so less than 500 million revenue range. So in that sort of market size, that's where there's much more opportunity for inefficiencies, mispricings, or opportunities for private equity managers to drive outperformance through better operations. And so the way things have been going over time, if we look in the top left, the number of publicly listed stocks, depending on when you look at it, has either decreased or been stagnant over time. And what's happening is more and more companies are choosing to stay private for longer. So they're older. So if we look at the median age, they're around 15 years old before they go public now, at least the median is, but the average market value is considerably higher than it used to be. And so for companies that are growing and their market values are increasing, a lot of that is happening in private markets now. And so by the time a company goes public, you've missed out on a lot of the growth potential. So what we want to do is, by investing in private equity, there is this one, bigger universe of companies. 2, the companies are available at relatively smaller size revenue. And then 3rd, kind of along with that, is it allows for more inefficiencies and ability to buy companies at more attractive valuations. And then there's more things for the private equity firms to do to drive earnings growth. Now, here's something that's a little different about private equity if you're new to it than when you compare it to the public stock market. Here we're looking at what would be called vintage years. So it'd be all the funds that were launched in any specific year. What was the range of returns for that vintage year and what was the median? As you can see, there's a decent range of outcomes. You know, if you're looking at the dot-com bubble, those were higher. If you're looking through kind of investing during the GFC, so that would be your 05, 06 vintages, those are lower. Now, this isn't that different than if I pulled pulled up a chart. What did the public stock market return in any given year? The public stock market has, I would say, a wider range of annual outcomes than this, but the difference is I can just go and invest in the public stock market through an ETF all on my own and hold that consistently through time, be diversified in, 10,000 different publicly traded companies. I can't really do that in private equity. And so in private equity, it is so much more important that you actually achieve vintage diversification. You can't just go, okay, I'm ready to invest $1 million in private equity and you put it all to work right away. One, it doesn't work like that. You have to commit capital, then it's called. And then two, you don't want to commit all of your private equity allocation you're looking for in 1 year, because what if that was 2005, 2006? What you want to do is you want to blend. And so you might ramp up your private equity exposure over 3 to 5 years. You commit $250,000 a year. And then eventually what happens is the earlier commitments you made start to return capital to you, and there's distributions. And then that funds your next investments in your next fund. And so it's kind of a moving target, but you're trying to maintain a consistent private equity exposure through time. I want to say that's hard to do. So like if you talk to anyone that invests in private equity today, they'll tell you the distributions have not been what anyone modeled them to be. And so a lot of people are either overweight in their private equity allocation they're looking for in their portfolio, or it might also be the case they are not getting to invest in the current vintages because they simply don't have the cash available to do it. Next, we're looking at performance. The reason everyone talks about private equity is it can deliver returns in excess of public markets. So if we look at over the time frame we've got on this slide, 2005 to 2024, you're looking at around 5% of annualized outperformance over the public stock market. And one thing that's different about private equity as well is the consistency. So if you look at this chart, you've got positive for performance for all but 2 years. Here in 2008, here in 2022, you're down only 1%. And the real reason for that is because private equity is less influenced by the sort of emotional swings in multiples that occur in public markets. What comes along with that is in large drawdowns that the public market experiences, you'll often see people get overly pessimistic, and then the multiples, the valuations on public stocks actually go below what they should be. And that's partly what causes the underperformance of public stocks in the years that private equity struggles. If private equity was being marked to market daily and it was subject to those same things, you would probably see bigger markdowns. That's just not how it currently works. So you have much more stability with private equity. The other thing I want to point out is that sort of excess pessimism that occurs in public markets, when it reverses, you see the opposite effect happen. So if we look at 2008, for example, private equity held in better than public stocks, but look at how public stocks ripped right back the following year. If we look at after 2011, public equity outperformed. If we look at after 2018, public equity outperformed. If we look at 2022, public equity outperformed. So you can see this sort of snapback effect in public stocks. Private equity is just a smoother ride overall, but including all of the years, you still saw private equity annualized at a higher return than the public stock market. Okay, and then next, I just want to look quickly at this brochure that Blackstone put together. It's publicly available. It's called the Essentials of Private Equity. And so this chart that they have is showing the same thing that JP Morgan was showing, where in this particular scenario, they're saying how many businesses with more than 250 million of revenue, what's that split between public and private? Well, the vast majority of companies with revenue of that much or greater reside in the private space. If you're someone that's like, I only invest in companies that have, stability and revenue above a certain amount, well, you're only looking at this big of an opportunity set as opposed to what's available in the private markets. Next, if we look at corporate revenues across the globe, you'll see it's actually more revenue from companies comes from the private sector than publicly traded companies. And then further, they've got some stats over here on the side that, things have moved since this was updated. But if you look at just the top 5 or top 10 companies in the S&P 500, they make up a huge part of the index because it's market cap weighted. So people think that they're super diversified when they own public stocks. In today's market, that's less so the case. And so there is a case to be made that by adding private equity, you are adding some diversification because you just have different companies, portfolio companies that you're invested in that you wouldn't otherwise be. And then next, we've got their sort of return comparison over this time period. They chose to include the GFC. We've seen around 6% annualized outperformance of private equity over publics. A bunch of disclosures that you should definitely check out. There isn't that there isn't tremendous consensus on how we should actually evaluate the performance of private equity, because you really need to make a public market equivalent, because it's kind of apples to oranges. This is people doing the best they can to compare them. In reality, some people take issue with this. So you do want to consider, how exactly are you evaluating your private equity performance? Are you looking at IRRs? Are you looking at multiples on invested capital? Some ways of looking at it make more sense than others. So just be careful if you're new to private equity that you understand how it's being marketed to you, because there's a lot of funny business that goes on in private markets. Next, we're looking at how much private equity exposure does the Yale endowment have, your average family office, which just means, family's worth it's around 300 million or more. That's when they'll have a family office, versus if we compare it to individual investors. Now, this is saying not just private equity, but all private market exposure is less than 3% for your average individual investor. Now, what this slide should not be telling you is, okay, I need 20% of my portfolio in private equity, or I want to be like Yale, so I need 41% of my portfolio in private equity. It's more a directional anecdote here saying, hey, compared to what sophisticated portfolios look like, you're probably underallocated to private markets and private equity. And so I would say it's directionally saying we should have more exposure for our $5 million plus portfolios that we're managing than simply having 3%. Lastly, we're looking at, they call out some of the different private equity strategies, and there's 5 kind of widely recognized ones. You got buyout, where you're the majority owner of a company. Growth is when you provide a minority investment in a company, usually when it's growing pretty fast. Secondaries is when you purchase existing private equity fund stakes from other investors that are seeking liquidity. And so then you get to buy their private equity investments at a discount. Opportunistic can honestly mean all kinds of different things. Something just that's not your typical equity check investment. I think a good example of that is the CoreWeave deals that a lot of private equity managers did, where they lent money to CoreWeave, and then those loans were collateralized. They were backed by the GPUs. And so that would be an example of an opportunistic deal that some private equity managers did. And then lastly, you got venture capital. That's that real early stage seed round funding, series A and B type stuff that some people love. It's not really my cup of tea. As I was saying, the range of outcomes is so large, and mathematically it's just on a risk adjusted basis. I'd prefer to sit in these other categories. Okay, so most private equity funds will invest in like 10 to 20 different portfolio companies. So if you want to be actually diversified and have over 100 different companies you're invested in, that's going to take a lot of private equity funds. I mean, it might take something like 15 different funds that you're allocated to make sure that you're properly diversified. And when you start looking at the minimum investments that these funds require, if you're going to go direct to them, you're not going to be able to get the diversification you need unless you have hundreds and hundreds of millions of dollars to sort of split up into different private equity funds. Now, I'm going to show you how we approach building private equity allocations, and how if you structure it correctly, you can make it tax-free. But before I show you the specific process, I want to be transparent about something. This sort of level of alternative investment access isn't something we can offer to everyone. It requires a significant net worth, oftentimes the QP threshold, which is the highest accreditation standard to be eligible for some of these things. You gotta have a $5 million net worth. And so this isn't something we can do for everyone, but if you are in that category, what we can do is get you access to some of the highest quality institutional investment products out there. We've got the relationships with some of the best investment managers out there. We have the scale to be able to get you access at lower minimums, and we've got the experience to properly evaluate and manage these investments over time. So if you're in that category and this is the kind of access that you've been looking for, then I'd encourage you to reach out and book a call after this video. Now, let me tell you about how we approach private equity. What we're able to do is get investors access to over 15 different funds, all in one subscription. And so this one product has over 100 different private equity portfolio companies in it across all these different kinds of strategies, like we were talking about with growth, buyout, life sciences, secondaries, tactical opportunities, all across the globe, and it can constantly be tactically allocated between where there is the most opportunity for deployment and the highest risk-adjusted returns in the space. And when we invest our money in it, it gets invested immediately. So instead of like your typical private equity structure where you commit capital to a fund, you start paying fees, and then you wait for the manager to call capital, and while you're waiting, you're sitting in cash, which is a drag in your portfolio waiting to be called. You experience what's called the J J-curve where your performance is actually negative in the early years until they start monetizing some of the investments and you get distributions. We don't deal with any of that. We're able to invest in hundreds of private equity companies all at once, just like that. And you can start compounding immediately. You're diversified across the different strategies, different vintage years, and all of it is professionally managed by what I think is the best manager in the industry. I worked at a firm that would build their sort of private equity portfolios for clients by sourcing different strategies and fund managers and trying to manage the different capital calls and things. And in reality, that creates large cash drags in your portfolio that you have to hold set aside in order to meet the capital calls when they come. You also have all kinds of style drift going on where a manager said that their growth, or they said that their buyout, or they said this is the stage they're looking at, and they start doing deals outside of that mandate. And so if you look at your private equity allocation, it's very rarely going to be what you were trying to make it. And then the last piece, and probably the worst one, is you have to wait for each one of those funds to give you a K1 before you can be issued your K1 for the fund to fund that you build to then file your taxes, and it never comes on time. So with the strategy that we're doing, your K1 arrives before your April 15th deadline and you can file your taxes on time. Now, if that wasn't enough, what puts it completely over the edge is you're able to put this private equity allocation in qualified retirement accounts. So this gets to my point on how can you make it tax-free? Well, if you put the private equity investment inside your retirement account, it's able to compound without taxes interrupting it. That's another difference I didn't mention between public stocks and private equity. Public stocks, you can manage pretty tax efficiently just by owning an ETF, and it's going to defer the capital gains until you actually sell the ETF. Private equity is not the same. You're constantly buying new companies and then you're monetizing and selling them. When you sell them, you trigger a capital gain. So if we go back to those comparisons where it was, 15% for private equity, 10% for public stocks, if this was out of your brokerage account, the tax drag on that 15% private equity is going to be pretty big. Now you probably make out, depending on your tax rate, better off than if you invested in public stocks. But if you're going to take that kind of risk and give up liquidity, you want to keep as much of that return as you possibly can. And so the way that we do that is we're going to do private equity out of your retirement account. Retirement account assets are some of the last accounts you're going to touch because frankly, you're not even allowed to touch them until you're 59 and a half. And then after that, it would be more efficient to let it keep compounding in there. And so what we do is in your brokerage account, we invest in a tax-aware hedge fund that gives an ordinary deduction. Ordinary deductions don't offset capital gains. They offset ordinary income. If you have private equity in your IRA, you can convert that investment into your Roth IRA, and that conversion creates income. Now, if you have a hedge fund that is giving you an income deduction, you can offset them. And so what we do is we map out how do we convert tax neutrally this private equity fund that's in your IRA into your Roth IRA where it's never taxed again and you're not going to be impacted by required minimum distributions in your retirement. You can just let it keep compounding in there. Now, if you don't have large retirement account balances, all your money for some reason is in a taxable brokerage account, do not fear. There is another way to make your private equity investments tax-free. And what you do is you pair a long-short tax loss harvesting SMA, which is harvesting a lot of capital losses each year. You have that going on here. And then you have your private equity investment in your brokerage account, which is realizing capital gains. The two combined together, you get capital losses to offset your capital gains, and then you can keep that full, if you were to hit it, 15% return a year with your private equity investments. Last one I'll touch on briefly is something called QSBS or Section 1202, and that is for earlier stage companies. If you invest in those, it's possible that you're exempt from some federal capital gains tax. It used to be $10 million. It just got bumped to 15, and it used to be for companies that had assets of 50 million or less on the balance sheet. Now it's 75 million. Used to be that you would have to hold those shares for at least 5 years. Now you actually can have partial exemption even if you've held them for less than 5 years. But what people do when they had big home runs, like let's say you had a 1000x on some early stage investment that you did, instead of that $15 million cap, what you do is something called QSBS stacking, where you make different trusts and then you move those QSBS eligible shares into different trusts. Each trust has its own $15 million QSBS exemption. So if you had a $75 million gain, all you would do is you would keep some for yourself, open up 4 new trusts, each of them get funded with 15 million worth. The key point is the beneficiaries of the trust are not you. So it's not like you could move those shares shares, sell them in the trust, not pay capital gains tax, and then take it back. I mean, that's not really the intent. The intent is you distribute it across your family, but you're able to avoid a lot of the capital gains tax. All right, so the reality is private equity can be a game changer for building wealth simply because you can compound at some of the highest rates of any asset class out there. But it only makes sense if you have access to the right strategies and managers. What we provide is legitimate access to some of the best investment managers out there and the proper due diligence and ongoing management that these kinds of investments require. If you're frustrated by the investment minimums on some of the products out there and you want to access the same caliber of private equity that the world's wealthiest families are doing, click the link in the description to book a call. We can walk through your specific situation and see where private equity might play a role in your portfolio and how we might be able to make it tax-free. Make sure to subscribe and check out the other videos on the channel to learn more about sophisticated investment strategies, and I'll see you in the next video.